Have you ever wondered if the people in charge of our economy actually know what they're doing? It's a scary thought, right? We trust central banks, like the Federal Reserve in the US or the European Central Bank, to keep our economies stable. But what if their actions, meant to help, are actually paving the way for the next global economic crisis? Let's dive into how the world's central banks might be setting us up for a modern-day Great Depression. It all started back in 2008. The global financial crisis hit, and the world was on the brink of economic collapse. To save the day, central banks stepped in with a radical new strategy. Quantitative easing, or QE. It sounds complicated, but the idea is simple. They printed massive amounts of new money and used it to buy up government bonds and other assets. This flooded the financial system with cash, pushed interest hedges projatus near zero, and was supposed to encourage borrowing and spending to restart the economy. And for a while, it seemed to work. Stock markets soared, unemployment fell, and we avoided a complete meltdown. But this easy money party couldn't last forever. For over a decade, we got used to this environment of ultra-low interest rates. Companies took on huge amounts of debt to expand. Investors piled into risky assets like stocks and real estate searching for any kind of return. And governments borrowed trillions for stimulus programs. The global debt pile swelled to astronomical levels. We were living in a bubble, and everyone was having a great time. But we forgot one crucial thing. Bubbles always pop. Then, the pandemic hit, and central banks doubled down. They printed even more money, sending trillions of dollars into the economy to prevent a COVID-induced recession. This, combined with supply chain disruptions, lit a fire under inflation. Suddenly, the cost of everything from groceries to gas skyrocketed. The inflation genie was out of the bottle, and central banks were faced with a terrible choice. Let inflation run wild and destroy people's savings, or slam on the brakes and risk crashing the economy they had spent a decade propping up. They chose to fight inflation. Starting in 2022, the Federal Reserve and other central banks began the most aggressive series of interest rate hikes in modern history. They jacked up rates at a speed we haven't seen in 40 years. This process is called quantitative tightening, or QT. It's the exact opposite of QE. They are now trying to suck all that excess money out of the system. The problem is, our entire global economy was built on the foundation of cheap debt. Pulling that foundation out so quickly is incredibly dangerous. So, how does this lead to a depression? Think of it like this. For years, the economy was like a patient on life support, pumped full of stimulus. Now, the doctors are yanking the plug out all at once. Higher interest rates mean it is much more expensive for companies to borrow money and service their existing debt. Many so-called zombie companies, which were only surviving because of cheap loans, are now facing bankruptcy. This leads to layoffs, rising unemployment, and a drop in consumer spending. We're already seeing the cracks appear. In 2023, we saw major bank failures, like Silicon Valley Bank, which collapsed partly because the value of its bond holdings exercises by rising interest rates. The commercial real estate market is in a nosedive as building owners struggle to refinance their loans at much higher rates. Credit card debt is at an all-time high, and delinquencies are rising. People are getting squeezed from all sides: high prices, high borrowing costs, and a wobbly job market. This isn't just a US problem. It's global. The US dollar is the world's reserve currency, so when the Fed raises rates, it sends shockwaves everywhere. Developing countries that borrowed heavily in dollars now find their debts cripplingly expensive to repay, pushing them towards default and political instability. Europe is teetering on the brink of recession, and China is battling its own massive real estate crisis and slowing growth. We're in a synchronized global slowdown, engineered by the very institutions meant to prevent it. The historical parallels are chilling. In the 1920s, a period of easy credit and speculative excess, known as the Roaring Twenties, led to the stock market crash of 1929 and the Great Depression. The Federal Reserve's policy mistakes, first by keeping credit too loose, and then by tightening it too aggressively, are often cited as a primary cause. Does that sound familiar? We've just lived through our own version of the Roaring Twenties, a decade of speculative frenzy fueled by central bank policy. Now, we're in the midst of the most rapid monetary tightening in history. So what's the endgame? There are a few possibilities, and none of them are great. Scenario 1. The central banks keep rates high to crush inflation, triggering a deep and painful global recession, or even a depression. We'd see widespread bankruptcies, mass unemployment, and a severe decline in living standards. It would be a brutal, but perhaps necessary, reset. Scenario 2. The economic pain becomes too great, and the central banks panic. They pivot, cutting interest rates and restarting the money printers to save the system from total collapse. This might provide temporary relief, but it would send a clear message. There are no consequences for bad behavior. This could lead to hyperinflation, where the currency becomes worthless, and an even bigger crisis down the road. It's kicking the can down a road that ends at a cliff. The truth is, we are in uncharted territory. The scale of the global debt bubble and the unprecedented nature of the monetary experiment we've lived through means no one knows for sure what will happen next. The central bankers are walking a tightrope with no safety net. They're trying to land a 747 on a postage stamp. One wrong move, and the consequences could be devastating for generations. The great financial experiment of the last 15 years is coming to an end. The artificial boom, fueled by printed money and 0% interest rates, is now turning into a bust. The very policies designed to save us from the last crisis may have sown the seeds for a much larger one. We can only hope the pilots of our global economy can navigate this storm without crashing. But it's wise to be prepared for some serious turbulence ahead. What do you think? Are central banks heroes or villains in this story? Let me know your thoughts in the comments below.